Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, July 13th, 2024. Hey, how's it going? I hope you're doing well. I appreciate you coming to my weekend review podcast. Boy, what a week last week. Had a big rotation, seemed like out of tech into the mid caps and the large industrials like the Dow and the IWM. But we'll talk about all of this. But here's the format for today. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week, both on the daily time frame and the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluence of signals were, and then most importantly, how I am going to manage the trade going forward. It's very important in trading that you pick your levels, you look for confluences, combinations of signals or supports, lining up position size correctly, enter the trade having a good risk to reward ratio, putting the trade on, and then knowing exactly what you're going to do regardless of what the market does. Before you get in the trade, you have all the control, how many shares you're going to buy, where you're going to buy, where your stops are going to be, what you're going to do with the trade. But after you put the trade on, then you are at the mercy of the market. So you better have a plan, you better have a process so you know exactly what you're going to do. And over the last almost 29 years now as a professional trader, that is what I have done and continue to do so to improve my approach is have an exact process. If this happens, I'm going to do that. If that happens, I'm going to do this. In my opinion, it really is the best, most holistic way to trade and most profitable as well. So this is what I'll go through and show you in my process today with these trades. So I hope it's going to be helpful. If it is helpful, I would appreciate if you could hit the thumbs up button. It really does help out the channel, lets YouTube know there's some valuable content here. After we go through the trades, we'll talk a little bit about trader psychology. Always the most important part in trading is the ability to follow the process that you've come up with. Sounds easy, right? We all know how to lose weight, exercise, eat better foods, eat less. Like we know how to do it, but do we do it? It's very similar with trading. It's not that hard to come up with a good trading process, but following it is a whole other can of worms. And that comes down to your brain, that comes down to your psychology. And that's why I like to talk about trader psychology. So I hope that will be helpful as well. And then after that, I have gone down through my watch list, both on the daily time frames and the weekly time frames. I have identified some potential trades and some potential levels that I'm looking for next week to potentially enter a trade, either to the long side or the short side. It's not there yet, but if it does get there, then I will consider taking the trade. On Friday nights, I always go through, when I'm prepared for the podcast, I always go through, look at the charts and go, okay, here's XYZ stock. Boy, if it came down another 2 or 3%, it would be at this level and that level, and you'd have these confluences. And to me, it works. It really works. You're not in the heat of the game during the day. You're looking at the charts when everything is nice and calm, and you go, if it did get there, that would be a good spot. It doesn't mean it's going to be a profitable trade, but it gives you a good construct and a good structure of a trade to go, oh, this is at the 200, it would be at the 30 RSI, there's a double bottom with a bullish divergence. If it rejects that level and gives me a good risk to reward ratio, then that would probably be a good trade to put on, win, lose, or draw. But so that's what I've done, gone through, show you the trades that I'm looking for and levels that I'm looking for next week. If they get there, great, I'll consider it. If they don't, then I'll just move on to a different ticker or different market that does get there. And that's how I do it. So anyway, I hope this is all going to be helpful for you. I hope you learned something. If you have any comments or questions about anything during the podcast, please put them in the comments section. I'll do my best to get back to you on that. And first of all, let's run the U.S. legal disclaimer, and then we'll get started. Hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started. Boy, do I have a lot of positions. This week has been fantastic with some trades, not so great with other trades, but all in all, very good, very positive. But boy, I have a lot of trades to get through, but I guess that's good, and hopefully it will be helpful because there's many different strategies that of all the trades I have, there are many different strategies that I have employed. So first of all, let's start with XLE. I did buy XLE back here on the 18th of June. Why? This is called a deep dip buy, one of the strategies that I use and teach. And let's bring your attention to the black line here. This is the 200-day moving average. This is an important level that large financials and savvy traders base their trade off of. So I did get long here on the 18th of June at 88.58. Why? Because the prior day we had a close below the 200 and then we had a close back above. Very simple, but now I have the support of the 200 underneath me. Now, like I said, I entered at 88.58. First thing I do is I position size by taking 1% of my account, dividing it by the value of the 2 ATR. This is how you position size based upon volatility. That shows me how many shares to buy based upon my account value. Then I place my emergency stop exactly the value of the 2 ATR below my entry. Now, the majority of my trades are end of day stops or end of bar stops, meaning that I won't get out of the trade until the end of the day. Now, there's an exception to that rule here on the emergency stop. If the very next day it had gone all the way down here, then how much am I going to lose? I'm going to lose that 1% because I already did the math by taking 1% of the capital, dividing it by 266. Now, fortunately, this only happens about 5% of the time. The other 95% of the time, when I have a loss, it will be because I have an end of bar stop. Well, where's my end of bar stop on this trade? Simply a close below this 200-day moving average, right? I mean, even if it closed 1 penny below, I'm simply out. So 95% of the time, if I have a loss, that's what it's going to be. So emergency stop, 2 ATRs below. End of bar stop on this particular trade, close below the 200-day moving average. Now I have an orange line up here. What is this? This is my 1.5 ATR trailing stop level. And all that means is if the price gets up to this 1.5 ATRs above my entry, then I go into what's called trailing stop mode, which means that if it does get to the orange line, to the trailing stop level, then if I have a close below a previous bar's low, I will sell half. Why do I do that? Well, if I've moved up 1.5 ATRs from my entry, I have a pretty good profit, and I don't want to give that all back, so that if I have a close below a previous bar's low and I sell half my position, it's like moving all of these stops up, right? And that's important. That's defensive. So the emergency stop, the end of day stop or the end of bar stop, the trailing stop mode, these are all defensive moves and defensive strategies, but I also play offense. It's important that you play offense and defense. How do I play offense? I play offense by taking partial profits when the price moves a certain distance from the previous bar's close. Let's take the most recent bar right now. It's at 90.56. What I do is I take the closing price, I add the value of the 0.45 to it. Right now that's 60 cents. So I would add 90.56 plus 60. That's my first profit target for Monday. I take the first profit target, add the 60 cents to it again. That's my second profit target. I take my second profit target, add the 60 cents to it again. That's my third profit target for Monday. So I always have 3 standing limit orders in that are the value of 0.45 ATRs from the previous bar's close. And if it moves that much, I sell 10% at each profit target based upon the amount of shares that I have left. Not that I started with, but that I have left. Okay, and that's the offensive part. So took the trade here with the close under, close over the 200. Like I said, again, this is a deep dip buy. Got in an 88.58, placed the 2 ATR emergency stop below, end of bar stops, closed below the 200, placed my 1.5 ATR trailing stop level above. And then again, if it moves up the value of 0.45 ATRs, I take 10% at that level, and I have 3 of them. So it's possible I could take a 10%, a 10%, a 10% if I hit 3. It's kind of hard to hit 3 in a day, but it's possible. I've hit 6 or 7 at some point in my career. But so here's the trade. Got in at 88.58. Next day, it moved up nicely. So what did I do? I believe I hit 2 profit targets on this day. So right off the bat, I took 20% of the trade off, reduced my position size. If I have a big reversal now, it mitigates the loss. And didn't quite get to trailing stop level. Next day we had a day down. Then we had a nice day up. I believe I hit 2 profit targets here as well. Took more off. Did get to trailing stop level, which means now I'm in trailing stop mode. So if I have a close below previous bar's low, I get out of half. And that happened here on the 26th. Had a close below previous bar's low. After reaching trailing stop level, I locked in, or I removed half the remaining positions I had for a gain of, what does that say? 2.22%. All right. Next day we moved up again. I don't think enough for a profit target. Next day we moved up again. I don't think there was a profit target there. Moved up again. Then we had this big down move, and I thought, oh boy, I may have to get out of the remaining shares. I'm glad I sold half up here when I had it, and I'm glad I took profits on the way up while I had it. But you can see we came right down to the stop, which was the 200-day moving average. Didn't close below it, didn't close below it. On Thursday, moved up, hit another profit target. And so far, that's how it's gone. The remaining shares that I have on this particular trade currently up 2.19%. So not too bad. Not too bad. And let's go to Home Depot. Home Depot, also a deep dip buy. And this is a really great example of it. This is a deep dip buy here at the 200-day moving average, the black line. Okay, why did I buy it? Well, this is called an intraday rejection of the 200-day moving average. You can see during the day, we went below the 200 and we closed back above it. So intraday it rejected the 200. In addition to that, we had what's called a V1. The V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I don't take the trade just based upon the V1, but it sweetens the trade. It gives it more bonus points, because I always talk about confluence or combination of indicators lining up. The main trade was that we had an intraday rejection of the 200, but the V1 helped add bonus points to the trade. And there's also things called V2s. V2s consist of 3 bars. If you'd like to learn more about V1s and V2s, just go to my YouTube channel. I have in the lessons playlist, I have a video there about V1s, V2s. They're a huge part of my trading. They really add a lot to my trading, and they'll add a lot to yours as well. So go and check that out. And so that was the trade. This is a great example of a good risk to reward ratio. Remember, I was telling you about being patient, waiting for it to come down and reject the level. Well, it did. It rejected the 200, and we also had the V1. I placed my emergency stop 2 ATRs below. My end of bar stop is simply going to be a close below the 200. I didn't know this was going to take off like this, But I did have control of going, look, I've got a really good risk to reward ratio. If the next bar closes even 1 penny below the 200-day moving out, I'm simply out of the trade, right? You can have big winning trades are allowed in trading, small winning trades are allowed, break-even trades are allowed, small losses are allowed, but what you really have to stay away from are the large losses. My largest loss potential on this trade is the 2 ATRs below. It's very unlikely to get there, but it happens. I have some trades today where it did happen that I'll show you, but it's very unlikely. Most of the time, if I have a losing trade, it's simply going to be that close below the 200. So I placed my 1.5 ATR trailing stop level up here. Next day moved up, took some profits, partial profits, hit 1. Next day down, next day moved up again. Believe I hit another profit target there. Next day moved up again, did hit 2 there, and I'm at trailing stop level. And then Friday again, more profit targets. Now, we are at a 65 RSI level. So now I have different rules that apply. The rule is, if I ever get to a 65 RSI level, see this thin blue line here? This is the 5 EMA. In the future now, if I close below this 5 EMA, I'm simply out of the trade. That's it. Because if I reach a 65 RSI level and lose the 5, I am out. Alternatively, if we go higher and we reject the 70 RSI, then I'm going to take half of the remaining shares that I have off. And if that happens, then if I have a close below a previous bar's low after rejecting the 70 RSI, then I'm completely out of the trade. I know this may sound complicated at first, but it's really not. And, I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course where I teach you all the rules, all the strategies, all the setups that I use. It's a great course. I've taught people from all over the world, and I think the best way to learn anything is one-on-one. But, in that course, by the time you're done with that course, you'll know all these rules, and they won't be complicated to you. But yes, there are a lot of rules for sure, but they're there for a reason. Every single rule I have is there for a reason, based upon experience, and that's why I have them in there. So this has been a great trade. We've had a big rotation, it seems like, out of tech and back into small caps and industrial stocks. Really based upon interest rates. Those companies are the beneficiaries of lower interest rates more than tech. And so that's why you're seeing, and people are talking about this great rotation from tech stocks, AI stocks. Money's coming out of those and into the mid caps and the industrials. So this particular trade right now, been a really, really good one. From the remaining shares that I have, up 6.98%. So great trade and a great example of being patient, waiting for a rejection of a major level, giving me a good risk to reward ratio. And this one really worked out. UNG, this has been a monster trade. Holy smokes. Short trade. So I did get short UNG back here on the 12th of June at $20.82. Okay, why? Well, it goes back to this bar here, this big bar, this big reversal bar here that rejected the 200-day moving average. Something changed with natural gas when this happened. And then we came all the way down. You see this trend line that I have here. This trend line was broken. Now, if you break a trend line to the downside, it doesn't mean you should immediately get short. What it means to me is if you've broken a trend line to the downside, now you are in a bearish market structure. If you're in a bearish market structure, you should, or I should, this is how I look at it, start to think about shorting rallies. Conversely, if you break a trend line to the downside, to the upside, then you should think about buying dips. Okay, so we broke the trend line to the upside, but the key is I wanted to wait until it came back and tested that trend line with the price being below the trend line, or some kind of rejection of a level. Now, if we would have just taken out this high here, then it would change the market structure back to an up market structure. But it tried, it sure tried, but I got short here when we rejected the 200-day moving average. I showed you on the last two trades, XLE and Home Depot, that I got long because it rejected to the 200-day moving average to the downside. This rejected the 200-day moving average to the upside. See how we went above it during the day, closed below it? I got short here at $20.82. One, because it rejected the 200. Two, it gives me a good risk to reward ratio. If we had to close back above the 200, simply be out. Of course, I have my 2 ATR emergency stop above here because I'm short. And then also bigger picture because we had this big break of a trend line and had a rally. So I got long here, 2082. I placed my 1.5 trailing stop level here. As it moved down, took some partial profits, took some partial profits, took some partial profits. Did get to trailing stop level, so now that means if I have a close above previous bar's high, I will get out of half. That happened here. We had a close above a previous bar's high after reaching trailing stop level. I locked in a profit on half the position of, what does that say, 5.27%. Pretty good. No, sorry. There we go. 4.84%. But I did keep the other half. Then we kind of moved sideways. Then we went down, took more profits, down, took more profits, down, took more profits. Now, just like I was talking about on Home Depot, if I get to 65 RSI level, then the 5 EMA comes into play. Well, it's the same thing to the short side. If I get to a 35 RSI level, then if I get a close above the 5 EMA, that gets me out of the short. Conversely, if we go lower and reject the 30 RSI, I'd get out of half. And then if we have a close above a previous bar's high after rejecting the 30 RSI, then I would get out of the trade. Okay, back to all the rules that sound really difficult, but really aren't. So this particular trade has been a monster. The remaining shares I have up 34.32%. Big trade. Caterpillar. All right, Caterpillar. Really nice example of a return, a higher low V1 in this case. Let me bring your attention to the two green lines here. This green line, this green line. Anywhere in here is considered the value zone. For this particular strategy, first of all, we need to close below the value zone, or in other words, close below the green line. We did. We moved in to the value zone. That's the second requirement. Third requirement is we need a pullback and then a V1. Here's the V1. Bar 1, bar 2 goes below the low of bar 1's low, closes above bar 1's close. But again, close below the value zone, requirement number 1. 2, come into the value zone. Requirement 3, have a pullback. Once that all happens, then if you get a V1 or a V2, that allows me to take the trade. So I did get long on the 10th at 328.20. Place my emergency stop 2 ATRs below as always. Now, on this particular trade, on a higher low or on a V1 or a V2, the end of bar stop is simply a close below halfway of the washout bar. This bar 2 is the washout bar because it washed out bar 1. If I get a close below 324.90, that invalidates the trade for me and I will get out of the trade. Place my 1.5 ATR trailing stop level above there. Next day had a nice move up, hit some profit targets. Friday had another nice move up, hit some profit targets, and also got to trailing stop level, which means now if I have a close below a previous bar's low, so Monday if we close below Friday's low, I would exit half of the remaining shares. If it keeps moving up, I'll continue to take profit targets. We're to 55.67 RSI. So in other words, if it gets up to 65, then what comes into play? The 5 EMA. So this has been a really, I mean, percentage-wise, not out of this world or anything, but pretty good, up 2.16% in a day. But it's a perfect example of a textbook perfect return, higher low V1 or V2. You see how this low here is higher than this low here. So below the value zone, into the value zone, pull back, V1 or V2. It's called a higher low V1 or V2 because this low is higher than this low. Lower lows tend to bounce, come back. Higher lows tend to trend, and that goes for even higher lows on 200-day moving averages, 250-day moving averages, under 30, over 30s, V1s. Anything higher low is better than a lower low. And conversely, if you're going short, let's go back to UNG. If you're looking to go short, lower low, lower highs. See how this high was lower than this high? Lower highs if you want to short, higher highs if you want to buy. I don't like to short higher highs. Higher highs tend to go down and then get bought, just like this one. Lower highs tend to trend. Higher lows, again, lower lows, when you buy them, tend to go up and come back down. Higher lows tend to trend. So that's, again, this is one of the things that I teach in my one-on-one course. Higher low V1s, V2s. It's a great strategy. So this one off to a good start, and I am in trailing stop mode. Okay. IWM. Again, this is a higher low V2. Here's the value zone. Closed below the value zone. Moved into the value zone. First requirement, second requirement. Pull back. Check. And then we have a V2. V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes below the low of bar 1's low. Bar 3 closes above bar 1's close. See how this low is higher than this low. This low is higher than this low. This higher than this low. So perfect, higher low V2. Got in 202.30. Place my emergency stop 2 ATRs below. My end of bar stop is a halfway of the washout bar right here. You can see here on the 9th, as soon as I bought, it went down, but look where it went to. It went to exactly halfway of that washout bar and bounced. Oftentimes there is a lot of support there, but it didn't close below. Had it closed below, I'd have been out of the trade for a small loss. Well, oh, sorry, I didn't put my trailing stop level on there. There we go. Right about here. A little higher than that. All right. So there's my trailing stop level. That's 1.5 ATRs above my entry. And so the trade just took off. Other than that first day. So got in at 202.30, went down, tested halfway, moved up. And Thursday we hit that huge day up. I believe I hit 3 profit targets on this day, and I hit 2 profit targets on Friday. Clearly, I'm at trailing stop level at this point. And now we're at 71.01 RSI. So this trade becomes very easy at this point. If it keeps moving up, I continue to take profit targets. That's all there is to it. Because I'm over 70 RSI, 70 RSI is a key level. If I now have a close below the 70 RSI, I'm going to take off half of the remaining shares of position. If after I eject the 70, if I get a close below a previous bar's low, then I'm out of the entire trade. If that happens all on the same day, then I'm out. So Monday, for instance, if we close back below the 70 RSI and close below Friday's low, that's it for me. That's it for the trade. But let's hope it keeps going up. I don't know, but it's been a really, really, really good trade. So up 5.11% in 4 days. It's a big move on IWM. So those are the open positions. XLE remaining shares up 2.19%. Home Depot up remaining shares up 6.98%. UNG short remaining shares up 34.32%. Caterpillar remaining shares up 2.16%, and IWM remaining shares up 5.11%. Okay, let's go to the closed trades. This is Tesla here. Really great trade. This, it's kind of hard to tell because the huge move up here, but I did get long Tesla on June 12th. Why? Well, this is a return to value V2. Here's the value zone, the two green lines. This is a little different than a higher low V1, V2. First requirement is we close above the value zone. Second, we come back into the value zone, which happened. Third, we need sideways motion. Well, we certainly got sideways motion. And then we had a V2. Here's bar 1, here's bar 2, here's bar 3. 2 goes below bar 1's low, 3 closes above bar 1's close. Of course, I placed my emergency stop 2 ATRs below, my end of bar stop halfway below the washout bar. I place my trailing stop level 1.5 ATRs above. If it moves up, I start taking profits. You can see it did move up, took some profits, got to trailing stop level. Then I had a close below a previous bar's low. I took half of the position off, unfortunately, but it's okay. It's just the rules for a gain of 0.48%. And then it just moved sideways, and then we had this huge run. Took some nice profit targets here, took some nice profit targets here, more here, more here, more here. This particular bar, at this point, we were in the 80 RSIs, so certainly above 65 RSI. And then on Thursday, we had the close below the 5 EMA after being at least 65 or higher. I locked in the remaining shares for a gain of 26.54%. Pretty incredible. And then Dash, okay, did not have all winners this week. Had a lot, but this one, no. Dash, I bought on the 1st of July with an intraday rejection of the 200-day moving average. Got in at 108.41. I placed my emergency stop 2 ATRs below. I placed my trailing stop 1.5 ATRs above. Next day we went down, tested the 200, held it, kept me in the trade. Next day same, kept me in the trade. Next day had a nice move up, thankfully, really thankfully. Why? Well, because I hit 2 profit targets on that day. I took 20% of the trade off, which is super important based upon what it did. Next day we moved sideways. Next day we moved up again, took some more profit targets off, thankfully, because on Wednesday we had a huge move down. And look, I got right to my emergency stop. This doesn't happen often. It happens 5% of the time, but this was one of the 5% of the time. So the remaining shares took a loss of 5.8%. But you see why it's so important that when you do have some profits, that you have a process to take off some profits so that if this situation happens, you mitigate your loss. Hey, I'm not happy about hitting my emergency stop, but I am grateful that I took some profits. Oh yeah, I took some profits here, took some profits here, took some profits here. So I reduced the position size, which mitigated this loss. But still, fact is that I just nailed that emergency stop, but I'm glad that I had fewer shares. So the remaining shares there, I took a loss of 5.8%. And then finally on Intel, all right, this one's a little complicated. Great trade, by the way. I had a really good setup. I bought this all the way back May 31st here at $30.29. Why? Well, let's take a look at this green box here. This is called the fair value gap, a bullish order block. So we had a low, we had a rally, we went lower. The key here was this move up here where I closed above this high. This changed the market structure to bullish. Once the market structure changes to bullish, I want to buy dips. Unless we take out this lower low and then it changes back to bearish. So anywhere in this green area here was a buyable area, which in hindsight looks obvious now, doesn't it? So I got long here at $30.29. One, because we came into the buyable area. Two, because we created a V1, bar 1, bar 2, bar 2 goes below bar 1's low, closes above bar 1's high. I got in at 30.29. My end of day stop on this particular trade is simply if we made new lows. My emergency stop, 2 ATRs below. My trailing stop, 1.5 ATRs above. Move down, move down, move down. Here had a little profit target. Here had another profit target, got to trailing stop level. Here on the 24th, we had a close below a previous bar's low. After reaching trailing stop level, I got out of half the position for a gain of 0.98%. And then we started to go up, took some more profits here. Obviously took two profit targets here, maybe three. Three here for sure. Two there for sure. At this point, I was over the 65 RSI level, and then on Thursday when we had the big rotation and the big move out of tech, I got out of all the trades for the remaining shares of 9.76%. So really, really good trade. So on the closed trades, recap, Tesla remaining shares up 26.54%. DoorDash, the long loss of remaining shares of 5.8%. And Intel remaining shares, the long of a gain of 9.76. Okay, so those are all the daily trades. Oh, sorry, very long. I realize that, but let's get over to the weekly trades. All right, let's get to McDonald's. So this one, a little bit of a tricky trade. I mean, not tricky, but I did it a little backwards, which is fine. If you've been listening to the podcast over the last month or so, you know I've been looking for this 200 week on McDonald's MCD. Even was up here. I was talking about, hey, if it gets down here, that's the spot I want. Wasn't even close to getting there, but this is what I was talking about. Just looking at a chart and going, if it ever got down there, that would be the spot to take a shot at it. So I drew this black line here at the 200 because what I was looking for was on the daily. If it got to that level, I may get a little head start on the trade. Even though I'm going to position size based upon it being on the weekly numbers, I'm going to place my emergency stop based upon the weekly numbers. Here it is, 2 ATRs below, 1.5 ATR trailing stop level above, and the end of bar stop being at the 200. But I really did feel like there were going to be some buyers at the 200 week. So I drew the black line at the 200 week. Now I entered on the daily. Look at that. Here's the 200 week moving average. And on this particular day, look what happened. It went below the 200 and then closed back above the 200. So that was my entry. Now, my position sizing, my end of bar stop, all that stuff is still based upon the weekly. But this gave me a little head start because it just poked below and then closed above. I got in at 245.90. And you can see I got a good head start on the trade. So I got in 244.90. It did move up. I mean, I basically got the bottom. It did move up for the 0.45 right now is $4.37. So I've already taken a profit target off based upon the weekly. So really nice entry, a little more advanced because I'm using two multiple time frames. But again, this black line was the 200 on the weekly. I could see that during the day on the daily, it went below, closed back above. Again, using multiple time frames is an important part of trading. It really is. And again, this is something I teach in my private one-on-one lessons to my to my students. So this particular trade on the weekly now is up 3.12%. I do want to point out, looks like here on the charts at the end of this month, we do have earnings. I never hold through earnings, so if I have a small gain or a big gain or a small loss, hasn't closed below the 200 week, I'll simply get out before earnings. So this one, good start on the weekly, up 3.12%. And then a closed trade on the weekly. This one definitely not so hot tamale. I've been in this trade for, it seems like a couple months. And I did get into this trade with a rejection of the 200 week moving average at 136.69. Placed my 2 ATR emergency stop above. My end of bar stop was simply a close above the 200 week moving average. It was also in a bearish fair value gap. And for the next, we tried to go above the 200, closed below, kept me in. Went above, closed below, kept me in. Went above, closed below, kept me in. And so it just did not like the prices above the 200-day moving average until this week. And then it had the big rally with everything else and had a loss of, almost got to my emergency stop again, which is very, doesn't happen very often. But it got close, and luckily it closed down a little bit. So this was a loss on this short of 5.76%. So recap on the weeklies: McDonald's up 3.12%, and IBB down 5.76%. So really great week of trading. Some really good setups. A lot of different, higher lows, V1s, V2s, return to value, V1s, V2s, fair value gaps. Bullish fair value gaps, and deep dip buys. So a nice example of all the different approaches that I use. And so sometimes it's a lot of deep dip buys. Sometimes it's a lot of higher low V1s, V2s. But this was a nice universe of different approaches that I use as examples. So I hope you found that helpful. Let's talk a little bit about trader psychology before we get into the potential trades for next week. Okay, this is from Dennis Kirui. Apologize, Dennis, if I didn't get that right, but I really like this trade here, and you can follow Dennis at Trader DKIRUI. So go ahead, check out his channel because I appreciate him posting this really nice post. Let's see what Dennis has to say. In trading, you have to be okay with losing small amounts for the potential of bigger rewards. There's a trading book called The Best Loser Wins. Sounds like a reality show, doesn't it? The Best Loser Wins. And just from the title, it captures why trading is different from other careers. You can't escape trading losses, just manage them. And Dennis is completely correct. In trading, your losses are just a cost of doing business. You're going to have them. I have them all the time. But in trading, if you win 50%, lose 50%, you can still be profitable because you're making more on your winning trades than you're losing on your losing trades. But if you can't take a loss, you should not be in trading. And just like Dennis says, the book here, The Best Loser Win, this sums it up the best. The person that can lose the best is going to win in trading. The person that can take small losses all the time and be okay with them, that's what it takes. Matter of fact, I have a student, a prior student of mine, very sharp individual, and I'm not going to say his name, but he likes chocolate, and every time he takes a loss, he rewards himself with a chocolate. Pretty good, right? He's trying to, he's trying to habituate himself into, well, take the loss. That's no good, but it is good, right? Doesn't seem like it's good, but it's good. Taking those small losses is right. And then he rewards himself with the chocolate. But Dennis is totally correct. In trading, you have to be okay with losing small amounts for the potential of bigger rewards. There's a trading book called The Best Loser Wins, and just from the title, it captures why trading is different from other careers. You can't escape trading losses, just manage them. He's right. You're going to have losses all the time. Embrace them. Be proud of yourself that you took them. Because one day you're going to buy something and it's going to go down and you should get out and you don't get out because you think it's going to come back, and it's going to keep going down and down and down and down and down, and you're going to look back and you're like, why the hell did I not get out when I was supposed to? Oh, that's right, because I thought it was going to come back. I've been there, folks. I have been there, trust me. The first loss is the best loss. Just get out. You can always get back in. So thank you very much, Dennis. And follow him at Trader DKIRUI. I'm certainly going to follow, and appreciate that great post, Dennis. Okay, let's get on and take a look at the potentials for next week. Now, I always say this before we start this. Right here, I have what on the daily. These are daily time frames. I have 10 potential trades. Theoretically, all of these could trigger on the same day. Does that mean I'm going to take 10 trades? No. I have a rule. I only take the best setup of the day. If all 10 of these trigger Monday, I'm going to take the best one. How do I know what the best one is? The one that has the most confluence of signals. The one that has the best risk to reward ratio. The one that looks best on multiple time frames, the one that has the best relative strength or the worst relative strength, depending if I'm going long or short. And if, it's like a report card. Okay, this setup here, it had, it had this and it had that. It has two. This one here, it has this and that. Oh, and this one on the larger time frame has this. And this one has this, that, and the other large time frame and has double bottom bullish, right? Okay, that's the one I'm going to pick. That's the one that has the highest score, right? Has the highest quality score. That's the one I'm going to take. So it's good policy. It's worked well for me. Again, these are things that I teach in my private one-on-one course, is how to identify what is the best trade out of a bunch of them that have trigger. So if you'd like to work with a really good trading coach, someone that have had a lot of experience, has taught students from all over the world, from absolute beginners all the way up to the hedge fund managers, that's me. I'd love to work with you. I will teach you everything I know. When you're done with this course, you will be a much better trader and have a lot of trading skills. So consider it. My email's in the description. Just send a email to me. We can get started. It does cost $1,750 for the course, but it's one-on-one. You get 15 hours of one-on-one instruction from me, and it's an investment. It's worth every penny. Okay, so let's start with CRM. Now, actually, a prior student of mine, hedge fund manager, brought this to my attention, and he was looking at shorting it. Well, there's a lot of potential for a short in CRM here. Let's break it down. There's a lot to be broken down here, but I think it's a good learning example. First of all, let's take a look at this trend line. Connect these bottoms. We broke it. If we break a trend line, what does that mean to me? That means that now we're probably in a bearish market structure, and I should probably look to short rallies. That's one from a trend line perspective. From a structure break perspective, ICT, this is ICT stuff. You can look up ICT on YouTube. If you have a high and then you have a pullback and then you have a higher high and then you have a big move down that takes out the first swing low, this also puts you into a bearish market structure. So we had the break of the upward trend line. The way that I look at trading, that puts you into a bearish market structure. From an ITC perspective, we have a high, pullback, higher high, big, strong, dynamic move down underneath the first swing low puts you into a bearish market structure. Now you see I have a blue box and I have a red box. The red box is a bearish fair value gap. This is the low of this bar 1, 2, 3, the high of bar 3 here. In the red area here, this is called the fair value gap. This is a shortable area just by itself. The blue box up here is a bearish order block. Why is it bearish? It looks bullish. Well, it's the highest high before the market structure close. Okay, so really from a ITC perspective, depending on the price action, somewhere between 256.70 and 265.46, somewhere in this area would be a good potential short setup because of the trend line structure break, because taking out the swing low structure break. Now, if you add on top of it the things that I do, you have the 200-day moving average right here. Well, this is going to be some resistance, and it falls right into this fair value gap, okay? Just like the trade, the huge trade, short trade that I had on natural gas, this is looking like a natural gas type of trade to me. Now, on top of this, and if you've listened to the podcast before, you'll see that I mentioned this very many times. 200-day moving average, black line, 50 moving average. See how it crossed below? That's called the death cross, right? When the 50 crosses below the 200, it's a death cross. What I have noticed in my experience in trading, when you have a death cross, the first move up after the death cross happens in rejection of the 200 is generally a very good place to short. And it goes the other way too. If you have a 50 crossing above a 200, then the first pullback to the 200 is a great place to buy. So there are all sorts of stuff. Now, because we broke this trend line to the downside, one of the best places to short is if you break a trend line to the downside and then it comes back up to that trend line, but underneath, pretty good place to short as well. In addition to the bearish order block, the bearish fair value gap, the 200. So how am I going to manage this, or how am I going to enter this trade? It's tricky. There's lots of different things and lots of different approaches I could use here. Monday, if we rejected the bottom of the fair value gap, that would be a potential. If we rejected the 200-day moving average, that would be a potential. If we go up higher, reject the bottom of the bearish order block, that could be a potential. Another way I could go about it is just to put on partial shorts on the way up. That's another way to do it. My stop, regardless of how I do it, is going to be a close above this high, because if we get a close above this high, then we're not in a bearish market structure anymore. So I can't be specific on what I'm going to take here, just some options, rejection of the bottom of this fair value gap, potential there. If it doesn't reject it, then I probably won't do anything. If it moves up, closes above the 200-day moving average, I probably won't do anything. I really am going to just wait for some kind of rejection. If it rejects the bottom of the order block, then potential. If it just keeps moving up and doesn't show any rejection, then if it rejects the trend line, then almost certainly I'll take that. But this is a really good example of many, many things coming together here. Trend line break, bearish order block, fair value, bearish fair value gap, death cross with the 200, taking out the swing low. So a lot of potential. I'm going to be watching CRM very closely for a short next week. Walt Disney. Okay, Walt Disney having a tough time of it. But we are at some, this would be a deep dip buy. We are at some potential levels here. We did go under 30, over 30 on Friday. Not really enough for me. If we had a double bottom, bullish divergence, something like that, then I would consider it. but we did go under 30, over 30. Remember when I told you that anything under higher low anything is better than lower low? Well, this is a lower low, under 30, over 30. Next week, if we came back down and went under 30 and then went back over 30 again, that would be a higher low, under 30, over 30. I would consider that. Conversely, if we go down, reject the 250 potential. If we go down lower to the 300 here, the 300 dovetails with the negative third ATR channel. That's why I kind of drew this green box here somewhere in this. I don't know. It might just take off and I miss it, and that's fine. But we are at some key levels on Disney. I know it's been out of favor, but there are some key levels. Low. We're in the low 30 RSIs. We have the 200-day moving, 250-day moving average. We have the negative 30 ATR channel. We have the 300-day moving average. So all sorts of potentials here. I'm just going to have to wait. But a higher low, under 30, over 30, I would consider that. Rejection of the 250, I would consider that. Rejection of the 300, I would consider that as well. Google. All right, well, you're going to see that on tech stocks, I am heavily favored to looking for shorts. Why? Here's Google. Look at the trend line. Here's the low here. Draw the trend line out. Okay, we broke trend line to the downside. So in the way that I look at the market, we've changed market structure to the downside. If we change market structure to the downside, I want to think about shorting rallies until the market makes a new high, then it changes the structure. Same thing as with Salesforce. Red area here, we have a bearish fair value gap. Blue area here, this is the bearish order block. You can see the red line I drew here. Why did I draw that? Here's halfway of a big down bar. If you have a big down bar and then rally back to halfway of that, there's some inherent resistance there. Okay, and that also happens in the fair value gap. So again, I'm gonna wait for something to be rejected. Could be the bottom of the fair value gap, could be a rejection of the halfway, could be the rejection of the bottom of the, a rejection of the fair value gap at the bottom, could be a rejection of the halfway of the bar, could be a rejection of the bottom of the bearish order block, could be a rejection of the trend line now that we're below it. So, but yes, I am very seriously considering shorting some of these because I think the move that we had down on Thursday was significant. Look at the volume that happened here. But you have to keep in mind that dip buyers, this came from a higher high. Very likely you'll get some dip buyers. But if the dip buyers buy and brings it back up and it fails, that's probably when you're going to get the leg down. That's kind of what I'm looking for, anticipating, but I want to see the market show me that it's doing that. I mean, I'm anticipating it, but I'm only going to enter the trade if I see some kind of rejection. So, but that's what I'm looking at here on short. So rejection of the fair value gap, rejection of the halfway of the big bar down, rejection of the bottom of the order block, potential rejection of the trend line that's above us. And my stop, of course, would be 2 ATRs above. End of bar stop would be if we just made a new high. Lyft, LYFT. Okay, we're down in some interesting areas here. Now, what brought or caught my attention on Lyft is that we have a double bottom bullish MACD divergence. Look at the red here, the MACD bars. We have a low, we have a rally. Now we're lower here than we were over here. Why is that important? It's important because we're lower here, but look, we don't have red bars here. That means that the momentum from a MACD perspective was much deeper over here. Now we're lower. We don't even have any red bars. That's insinuating is that you are running out of sellers. If you run out of sellers, then the implication is you're going to go up. So I'm looking for different possibilities here. A rejection of this 300-day moving average, the orange line, this could be a potential entry. If we go lower, a rejection of the 30 RSI could be a potential entry point as well. So I still need a trigger to get into the trade, but big picture here, I like the double bottom bullish MACD divergence. That's what's you know, that's what's brought this trade to my attention. Big picture, I like that, but I just need the trade. Rejection of the 30 RSI, rejection of the 300-day moving average is what I'm looking for. McDonald's. Okay, so I told you that I bought McDonald's on the weekly, entered on the daily, but bought on, managing this trade on the weekly, and that I already took a profit target because I got in a little early based upon the daily. So I already took a profit target off. Well, I'm potentially looking to add back that portion of the trade that I took off up here. Why? Well, we've had a structure change. Look, here's our low. We rally, we make a lower low, and then on Thursday, we took out the first swing high to the left. What does that mean? To me, that means that we have changed market structure to the upside. Here's the trend line. We've broken the trend line to the upside. So if you go from a bearish market structure to a bullish market structure, what do I want to do? I want to buy dips. If we go from a bullish market structure to a bearish market structure, I want to sell rips or I want to sell rallies. So here, this green area here, this is a bullish fair value gap. Bottom of bar 1, low of bar 3. This is just an area that has not been tested yet because we ran right through it. But if we do come back into this area, I will consider adding back the partial profits that I already took off. And if I wasn't in McDonald's already, based upon the rejection of the 200 on the weekly here, I would look potentially add in this bullish fair value gap because clearly the structure has changed to the upside. It might just keep going, fine. But I am looking for a pullback into this fair value gap to potentially add 245.90 up to 240 or 250. So that's what I'm looking for. And if I wasn't already in the trade, this is where I entered the full position of a new trade. My stop would just be a low here, that close below this low. Meta. Okay, again, back to bearish stuff. Meta has changed structure to the downside in multiple ways. Here is the long-term trend line, broke it. We also took out, no, sorry, we didn't do that. But yes, we took out the trend line to the downside. To me, that changes market structure to the upside. Again, we have the same thing. We have a bearish fair value gap here in the red between 509.29, 528.86, and then we have a bullish order block here from 528.86 up to 538.91. So a lot of range here. Just can't go ahead and short stuff because there's a lot of range that could get me here. So I'm going to have to really think about this, how I'm going to potentially enter this trade. If we reject the bottom of this order block here, of the fair value gap, I don't think I'm going to take the trade because it's such a long way up if I'm wrong. I could potentially take it, really reduce my position size, but I don't think so. If we come up and reject this trend line, that would also be a potential, but I still am running into the problem that I have a lot of range to my stop. If we reject halfway of this big down bar here, then I could get a little bit more serious about potentially taking the short here. My stop would be here. This is the closest swing high. If we got to the bottom and rejected this bearish order block here, then I would definitely feel really comfortable with taking the trade because my risk to reward ratio. So that's the irony of this trade. Lot of anything bearish, you theoretically could short anything bearish in here, but your range to your stop is extended. So I'm just going to have to see, but things have definitely changed with Meta. Clearly, something has changed. Sentiment, rotation into other industries. So, but to me, this is a downtrend. I need to short the rally, but I have to be patient. My ideal would be shorting the bottom of this order block here at 528.35. And I may just not get this trade. It may rally a little bit and then have a big move down, and I don't get it. But I'll have other things that are short, potentially, that have better risk to reward ratios. Same with Microsoft, MSFT. Here we go. Okay. Well, long-term trend line, we busted down. Swing low, we busted down. So in every metric, the way that I look at it, this is changed structure to the downside. I want to short rallies. Here's the fair value gap between 456.62 and 458.70. Again, I don't think I'm going to short in here because of the range. In the blue area is the bearish market structure. Is the bearish order block. This is potential, but again, the range is so high. What I'm really going to pick here is if we come up and reject somewhere here with the trend line, because if we have the big move down, change market structure to the downside. If we rally back up this trend line, or rejection of this trend line would make the most sense, depending where it happens at about 462. So a lot of possibilities there. I wish I could be more specific, but it's not just like a 200 where I'm in above, down below, or I'm, short below, out above. This is going to be tricky here, but big picture, if I had a V1 or a V2, the downside and rejection of the trend line, that may make me pull the trigger as well. But this looks bearish to me. NVIDIA, same story. Same story. Look, here's the trend line here. We broke it. Look, big bar to the downside, halfway right here. We broke the trend line. I was expecting a rally. We got the rally. Look what happened. It got right to the halfway and failed. Okay. Now, more recently, we had the huge move down on Thursday. We also had halfway here. Look what happened on yesterday. We got right to the halfway and failed. So what I'm looking for here on NVIDIA, anywhere in this red area, this bearish order block is shortable. But what I'm looking for is this long-term trend line that we have here. If we come back up and reject that trend line, I potentially would get short. My ideal spot is the intersection of this trend line and halfway at the big order block back on 620. So just to make it easy, 134.60 or rejection of that level would be a key short area for me. SLV, silver. Okay, well, let's talk about abandoned babies and island reversals. If you don't know about them, I have a video in my YouTube channel. This silver created an abandoned baby, which is bearish. Look, we gapped up. Everything was great. Friday, we gapped down. See how it leaves it up here, a gap up, followed by immediate gap down, changes this, the way that I look at this, as very bullish to very bearish very quickly. When that happens, more times than not, if you look out into the future, you will see lower prices. So I'm looking for a short on silver, but I'm looking for a move back up to close the gap here at this bottom. So I'm looking for a move back up to 28.48. So if it moves back up there, then I will get short. On these particular trades, very easy for me. I place a 2 ATR emergency stop above, a 4 ATR profit target below, and then I set it and forget it. That's all I do to the trade. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. One of the two. And that's how I approach abandoned babies and island reversals. But again, we had a quick move up, followed by immediate move down. This shows that more likely than not in the future will be lower when that happened, because things were great to really bad. Not expecting to have, wouldn't be surprised to have a move up. People buying the bounce, but this is what I'm looking for. If we get to 28.48, I will consider getting short silver, 2 ATR stop above, 4 ATR profit target below. And then last but not least, SPCE. Okay, Virgin Galactic. Look, we are still in a bearish market structure. We have a low, we have a rally, we made a lower low. If we can take out this high at 880, this would change market structure to the upside. If we change market structure to the upside, then could have a fair value gap or have a bullish order block. Right now, it has not changed to the upside. But if it does change to the upside, then right here at 783 would be the top of the bullish order block. So it just want to reaffirm, it is not in a bullish market structure yet. It may just go back down. But if we had a sometime next week or whenever, if we have a move above 880, then it will change to the upside, change to a bullish market structure to the upside. Then I will look to buy dips either in the fair value gaps, which are not there yet. But I do know what the order block is. The order block is here at 783. So if we change market structure to the upside, then come back to 783, I will consider taking the trade. In addition to that, we're going low, lower low, and even though we're lower here, we have green MACD bars instead of red MACD bars. So there's a double bottom bullish divergence in there. All right, so those are the dailies. Let's get to the weeklies. I only have a couple of these. Okay, Intel, I got out of Intel, as you know already, but on the weekly, we have changed order block. This is similar to Virgin Atlantic, yeah. But look, we change structure to the upside on the weekly, certainly. Here was the first swing high. Now I'm just looking for a pullback. Once you change market structure to the upside, I look for a pullback. So on the weekly, somewhere between 32.82 and 31.14, anywhere in this green area, I would be looking to buy a dip. Yes, I did get out on Thursday because of the big reversal. So, but big picture, Intel has changed market structure to the upside. So I'm looking to potentially re-enter long Intel with some kind of pullback here between 32.82 and 31.44. And then last but not least, Netflix on the weekly. Okay, as far as tech stuff goes, almost everything has broken structure, and we did break structure on Netflix as well. Here's the first swing low, broke it. This makes this red area here a bearish order block. Halfway the big down bar that we had this week at 669. If I wouldn't be surprised to have a rally, not at all. But if we come back up next week and reject 669, which is halfway the big down bar and in the bearish order block, I will definitely consider getting short Netflix with a close above 697.49 would be my stop. So, boy, went through a lot of stuff in this podcast. If you made it all the way through, congratulations. Like I said, I hope you found it helpful. If you did find it helpful, I would really appreciate if you could hit the thumbs up button. If you'd like to learn more about my one-on-one course, just send me an email. Email's in the link of the description. Generally what I do, if I have people that are interested in taking the course with me, I usually just have a free Skype call with them just to learn more about them, their trading, their challenges, their goals. It's a great time for them to ask me questions about the course. And then after that call, there's no pressure whatsoever. If you decide that you want to do it in the future, just email me back and we'll start the course. But I promise you're going to be glad that you did. I have a great online course available at udemy.com. The link's in the description, where I teach you step-by-step how to trade the deep dip buy stock trading strategy. It's very affordable. I think it's around $30 to $40, but you get a lot of content. You get 9.5 hours of video, and I teach you how to trade the deep dip buy stock trading strategy, which is a great strategy. Really, really is. I have been trying to do some quick 10-minute videos on day trades during the week. So look out for those. And, kind of shows you the different approaches that I use and how they've worked out. But I really appreciate you being here, everyone. I hope you have a good rest of your week. If you have questions, put them in the comments section, and I'll do my best to get back from them. But please, I always like to end off with, please try to do something nice for someone today. It really would make the world a better place if we all could do something nice, and if you could do something nice for an animal as well. They appreciate acts of kindness just like we do. So thanks a lot, everyone. Appreciate you being here, and God willing, talk to you next week. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.